Okay. Yeah, actually, it's really neat. Looking back to 2013 as I was writing the 2014 outlook, and I went back and I even looked at the start of 2013 and what our outlook was at that point in time in 2013. And one of the main themes of 2013 was, will we ever get a rising trend in the price-earnings ratio? And obviously, what I mean by that is if Eli Lilly makes $1 and it trades at 14 times earnings, it would trade at $14 a share. Well, historically speaking, a lot of bull markets in the country have expanded those bull markets by, instead of trading at a 14 multiple, maybe it rises to a 16.5 multiple or something like that. And so therefore, even if earnings stayed the same, Eli Lilly, instead of trading at $14, would trade at 16.5, and therefore return about 15% on your money. Well, we didn't really see that in 2012. In fact, in a large part in 2013 at the start, we really did not see much expansion in the PE multiple. In fact, the majority of the increase in valuation in the stock market has really come on the back of increased earnings. Companies are just that. They're more profitable than they were in 2012. And so 2013 shaped up to be a pretty decent year. We'll talk a little bit about the PE multiple, because a lot of times people have this misnomer that they believe that the PE multiple cannot expand in a rising interest rate environment. And quite frankly, that's just not the case. The first graph that I'd like to just point your attention to as we talk about those earnings that I was just speaking about, because now looking into 2014, really I tell you, 2013, you can see there in the middle, we were somewhat flattish, in fact, in the majority of the earnings. In fact, a lot of us, we never saw any revenue growth, but we did see 7-8% earnings growth. And that earnings growth, again, coupled with a little bit of PE expansion in 2013, really translated into a 30% return on the S&P 500. For those of you who are invested with Ed and through some of our portfolios, obviously some of our investments gained more than that and beat the markets. But it really was a story of increased earnings again, coupled with a minor amount of PE expansion. And a lot of times, towards the end of bull markets, we see a huge PE expansion. And quite frankly, we just haven't seen that. In fact, looking at that graph on the improving growth rates, you can even continue to see that growth rates are actually starting to pick up. In fact, revenues are starting to pick up a little bit. And that minute rise in revenues will really be translated to higher earnings at the bottom line. And I think that's what we're looking at again in 2014. By the way, I don't believe ever in history have we ever had an increase like we did in 2013 without the next year or the follow-up year being positive in the overall stock market, which I think is a really interesting historical fact. Kind of turning your attention to that second graph I have out there, the PE ratio versus the real long-term treasury yield. Hey, unless you've been sleeping under a rock, as you know by now, the government is going to start its tapering of buying debt. Amazing, right? All these years spending $80 billion a month in buying fixed income. Now we're going to start, I guess, to slow that down a bit. Well, actually, that's really welcome. That's welcome news. As you can see, that news of the tapering, or that expectation of the tapering, has actually increased our PE multiple. And that graph clearly shows that even though we've been in that 1 to 2, or between 0 to 1 and 1 to 2% real long-term treasury yield, okay, our PE multiple has actually stayed relatively low, when in fact we believe that the 10-year treasury will ultimately get to a real yield of somewhere around 3.5 to 4%. We could even see further multiple expansion, which very easily, and by the way, I'm not calling for this, but it very easily could send the market up another 20%. It's very possible, okay? So let's just forget the old misnomer that people think, oh, well, if rising interest rates are going to cost everyone more money. That is true, and obviously there's other things that we want to make sure we're paying attention to. Obviously, what's going on in Washington with the budget process. We want to make sure that the folks in Washington, quite frankly, both parties keep their hands off the pot, so it can just sit there and boil on its own. But I do think it's interesting to take a look at the PE ratio versus the long-term Treasury yield. And really, if you couple that with some unemployment numbers, unemployment has been getting a little bit better, albeit I would warn you that there may be, I don't want to dare say manipulation, but the real unemployment rate as calculated years ago is still fairly elevated because the participation rate, people that are basically dropping out of the employment race, is dwindling, and therefore the unemployment rate has been decreasing because of that, not necessarily because of the huge creation of jobs. In fact, last month was a little bit tame, but some of that could have been weather related. We'll just have to see what comes up here in the next month. Okay, and I'm sorry I'm rambling on here a little bit. I want to talk to you about the third chart. And by the way, a lot of you can see this in the 2014 Outlook, excuse me, that Ed has, and kind of our thoughts on that 2014 Outlook, and I think Ed will be providing that to everybody. But this third chart is really a theme that we've been playing for years, and quite frankly, I believe it's an ongoing rationale as to why the stock market will continue to increase. And the numbers I have circled there are simply this. It's supply and demand. Many of the companies are actually out there buying their stock back. We've often said for years that Microsoft could go private in about 9.5 years. They have the cash flow that they could buy back every share of stock on the open market and never be a public company again. That's what's been happening over the last several years. Companies have been buying back their stock at record paces. You can see there that the supply of stock has continued to decline. And that decline has actually has translated into not only higher earnings for companies as there's less shares to spread the wealth amongst, but quite frankly, just like if there's one T-shirt left on the shelf and Ed and I were fighting for it, one of us is going to win, right? So, anyways, I think there's just less stock out there. The fourth graph, just to point your attention to this, and this is one of the reasons I do think the stock market will continue to push higher. We are seeing a very low participation rate in the stock market. You can see I think we're right around 52%, maybe even a little bit higher today, but right around 52%. People have not come back to the stock market since 2008-9. They're still scared. And quite frankly, we understand that. But you also have to realize that maybe a 50, 60-year-old person needs to be into the stock market somewhat or have managed investments because, quite frankly, life expectancy is probably in the 80s, another 30 to 40 years of life. And you can't stop investing because right now, especially if you're in the bond market, that's, unless you're buying bonds to hold, as we do in our fund, you might be in for a rude awakening. I mean, you probably had negative 2-3% returns last year on the bond side. So, again, the participation in the stock market is very limited or is depressed because people are just afraid to get back in. And we all know what happens. When the Indiana Pacers here in our own hometown are starting to do well and have the best record, they're selling out again. But for years, when they were depressed and, quite frankly, had a lot of scoundrels on their team, they really they weren't selling out. They were having a tough time selling tickets. And, in fact, even this year, once they started winning, and Jeff Bell lives in Indianapolis as well, we both know that they were putting out promotions, trying to get people to the games. They couldn't even get people to the games, and they were winning. But now that they have the best record in the NBA, they continue to win, and the folks are coming out of the woodwork and once again driving up those ticket prices that the scalpers are trying to collect on the streets, and therefore more people are getting engaged in the game, and prices are moving higher. Stock market's no different. Everyone likes to be part of a winner. In fact, if the Denver Broncos end up winning the Super Bowl, although Peyton Manning is a winner, Denver's picked up a lot more fans probably since he's gone to Denver. I can tell you this, if Denver wins the Super Bowl, more people will buy Denver shirts than Seattle Seahawks shirts. I'd say that's a pretty safe bet. And vice versa, if the Seahawks win, More people will buy Seahawks jerseys. Why? Because people like to be associated with winners. Okay? The stock market's not going to be any different this time. Okay. The last chart I'd like to point your attention to, and I find this chart really interesting, and I did not include this in the 2014 Outlook, but I really like this chart. And what it is, it shows how typical, or a comparison of our current bull market versus secular bull markets that we've been in since 1897. So we see those back to 1921, 49, 74, 82, 87, and 02, and we kind of see how the market behaved in the years into a bull market from the start date, not necessarily the calendar date, but the start date. And it's really uncanny. If you look at that blue line, the current bull market, that really resembles what we've just been through. Once again, the first year, it's way up because we did have depressed earnings in the 08, 09, market crash, and things then came back, roaring back, and then obviously a slowdown typically in earnings, and we're seeing the same type of thing. And again, history says we could possibly see a gain in 2014 of 20%. I don't think so. I think it's going to be more in the tune of 9 to 14%. In fact, I'm probably more towards the lower part of that than the higher part, unless we see some PE expansion, and that's just clearly based on the numbers. But I really do think it's interesting that if we take a look at this bull market, I don't think this bull market's over. I really think if the employment situation does get better, I think if the government can keep its hands out of the cookie jar, we will see a stock market that can recover. I don't want to talk politics, but I don't care whether you're Republican or Democrat. To some extent, pin-up demand from either party is not going to be able to suffocate the markets to the fullest extent, unless we come up with some kind of crazy regulation that really stifles growth in the markets. Everybody's keeping an eye on the health care, the Affordable Health Care Act. There is some issues there. We understand that with the healthcare industry. Obviously, we're keeping an eye on that. But even with that, quite frankly, the government runs everything pretty inefficiently, as we've clearly seen by the website and what's going on so far. And I would probably conclude that from that they'll operate the Affordable Care Act in an inefficient manner, and the healthcare companies will make money hand over fist once again, until they figure out that the government really shouldn't run anything, except maybe how to get to one coffee shop to the next, okay, for the politicians. Anyways, with that being said, that's really kind of my 2 cents for everyone this morning, and I'm quite enthused about the market. I'm quite enthused about our returns last year for our investors. I feel like we really had our eye on the ball, and I've been feeling that way for the last couple of years, and I continue to feel that way currently. Quite frankly, I put my money where my mouth is. I'm invested in the same thing, and so with that being said,
again, my name is Troy Patton, and again, we work with CPAs and accountants throughout the country, and work with their clients and managing their model portfolios, and we look forward to working with you or answering any questions that you may have at any time. And again, my name is Troy Patton, and you can always reach us at 1-800-800-1776. Thank you very much, and have a good day.